Hi, my name is Frankie. Welcome back to FAQ Show. Right now, the market feels like it's on edge. Everywhere you look, it's the same story. Volatile asset prices, investors getting jittery, and headlines screaming about inflation, geopolitical tension, and rising interest rates. It's the kind of environment that makes most people feel like pulling out altogether. But what if I told you there's a corner of the market that actually thrives in this chaos? While most investors are trying to make sense of these unpredictable swings, savvy traders are turning to energy futures, especially crude oil, as a way to capitalize on the very factors that are scaring the rest of the market. And it's not just speculation, it's strategy. And to help us decode all of this, from how oil prices are really moving behind the scenes to how you can start thinking about energy futures in your portfolio, I'm speaking to someone who lives and breathes this market every single day. David Ng is a full-time proprietary trader at Iceberg X. He holds the Chartered Market Technician designation, and he spent years studying and trading commodity markets like crude palm oil and crude oil. You may have seen his insights in The Edge, The Star, or heard him speak at seminars across the country. Today, we're lucky to have him right here on the FAQ Show. If you have even been confused about why oil prices are falling despite inflation, or wondered how traders actually use seasonal patterns and inventory data to position themselves, this is the episode you don't want to miss. David, I have this one interesting question in mind, right? If you look at the crude oil prices, it's been going up and down. I think the highest point in history is about $120, $130 per barrel. And I think the lowest was negative. That one incident, that price, don't know what happened, it just fell to negative, but it bounced back very, very quickly. But if you look at the average, it hovers somewhere around $60 to $80. But if you zoom into 2025 alone, right, it has been on a downtrend. And this caught my attention because with geopolitical tension and then the US policy uncertainties and stuff like that, right, everyone was expecting inflation. Inflation means your energy prices go up, right? So, in your opinion, why do you think crude oil prices is coming down?
Yeah, I think that there's several factors that actually can describe, why crude oil prices, actually been on a declining trend. I mean, you pointed out quite accurately. You had people expecting, commodity prices should go up. With all this, trade war that's happening and geopolitics kicking in. So generally, you should expect, commodity prices should be rising, but we don't see that in crude oil. I think it's mainly down to, I think the projection. If you just look at where, everybody's expecting the economy is going to hit, whether they talk about global economy, at least for the foreseeable next couple of months, it's actually not looking good. If you just take, for example, the IMF, so-called, everyone is looking at what's their economic projections like. They're expecting, I think, at least the second half of 2025 is going to be bad. We started off January 2025, they were expecting that this year the growth should be around 3 to 4%. But I think the latest report that came out last month, it shows that now they're expecting growth is going to be only 2 or 2.5%, which is a big downgrade. So I would say this, why crude oil prices has not been doing well is mainly because I think people are expecting the economy global economy per se is going forward, it's not going to be good. So I think therefore people are slowly a bit more cautious. And oil is a very major thing. Whether you talk about your airline, whether you talk about your traveling, all involves oil. The demand for oil. So when people are starting to be more cautious, when people are not looking too optimistic in the future, so they'll pull back. They will definitely pull back on the demand for traveling and whatnot. So generally, I think why market is reacting as such, why prices has especially oil prices has been coming down, is actually mainly in response to that. So, in short, I think because of, people are expecting that the global economy is not going to do well with all this geopolitics, trade tension and whatnot, it's definitely going to be a factor that people are watching closely. And therefore, as a result, people are slowly holding back on whether it's traveling, whether it's spending or whatnot. And therefore, actually that translates into lower demand for oil. And that explains why prices have actually been coming down.
Right, that's very interesting because on the headlines, people will see that, inflation is coming, things are all going up. But now hearing from you, there's actually another layer that influences the oil price that may potentially come down instead of going up. But I understand in terms of crude oil futures trading, in particular? Apart from all these things that we can read from the headlines, from the news and all that, there are also a few indicators that you all pay attention to. For example, what is the inventory level like? What is the OPEC doing that will influence the crude oil prices and stuff? So while we read the headline and we kind of know what's going on there, but at the same time we are like half pail full, half pail empty. We are not really sure what we are reading. So can you help us to understand what do this news or all these insights tell us about the crude oil price movement?
Okay, well, I think when you specifically look at the oil market, obviously, if you are trading the market per se, there's always this there's a few key reports that is worth to watch at, especially with OPEC report. Even we have the US weekly, we call it EIA report, which is very crucial. All these reports is important for us to gauge, overall how is the market doing? Are we in a situation where it's an over demand or over supply situation? So obviously there's a lot of headlines, but just to streamline for the audience that's tuning in, I think it's important that, if you are looking at the oil market, there's the key reports are always the OPEC, where it's monthly. Then if you want a weekly, which is shorter edition, you have obviously the US, EIA reports. Now, I think so far, if you just read all these latest reports, it does indicate to you that, and I think going forward, they're also not too optimistic. That's why you can see oil prices actually being very pressured. And the added uncertainty, the element that is always in people's mind right now is how will this trade war between US and China is going to play out? Because eventually all this will have a repercussion, not only in these two major economies, but across the world. So that will also affect oil. So I think crucially, look beyond what the crucial headline is, focus on, especially we are in the oil market, focus on those key reports which I just mentioned, and most important, observe what is happening, especially when it comes to trade tensions between these two countries, because ultimately, US or tariffs will have major repercussion across a lot of other sectors, and that is including the oil market as well.
Right, but how do we make sense of those reports? For example, the US may come out with their inventory report. So how should we read that and anticipate how the crude oil price is going to move?
Okay. Now, I think US, if you just look at inventory per se, if you just look at a weekly basis, I think crucially, if you are in the oil market for quite some time, you notice that it's always a pattern, a seasonal pattern. There's always a period of time where inventory starts to build up, especially when you hit into the US summers period. So these are all seasonal patterns. Now, if one to interpret the inventory reports, one will look at how do we make sense out of it. So obviously, when inventory starts to build up, probably around middle of June to August period, where they in anticipation of the winter season, normally you start to see inventory starts to rise, and then that usually foretell that the market is anticipating that there's more demand because US is trying to store their reserve into excess inventory. So there's naturally more demand for oil. But eventually, when there's also rapid depletion of inventory, according to those inventory reports, that also does indicate demand is strong. So right now, if you just look at if just based on inventory reports, it does indicate to you inventories are starting to build up. That explains why also prices are actually very weak. Now, there's also another element to that. If you look at, we always term this in the market strategic petroleum reserve. US has always this so-called oil reserve. And if you recall back to 3 or 4 years ago when oil prices was at above $100, that's where this US starts to really let go of all this reserve, all this inventory. So there's always a period of time where market will always expect the government, US government will probably tend to replenish those supplies or those inventory. When they do that, that means there's additional demand for oil. So I mean that's one way to look at it in terms of inventory. Whether is there a depletion of the inventory numbers. If that shows, it tells you that generally the market is still quite positive. But if there's a build up in inventory across the board, I think that's also indication that the market is actually very weak in terms of demand. So two things. I think one thing is to make sure how is the level of inventory is playing out. Are we watching rising inventory or lower inventory? And second thing is always the strategic petroleum reserve, which US, is everyone is watching closely. there must be a time where US government will come to the market and buy and store back to their reserve or replenish those supplies. And when they do that, that means there's additional demand coming for the US oil market. So, if you are watching closely on oil market, these two inventories reports are very crucial.
Ready to level up your trading game? Affin Hwang Investment Bank Trade, Win and Repeat CME campaign is here with exciting rewards. Trade CME Group products via Affin Hwang Investment Bank Berhad and climb the leaderboard for a chance to win up to 5,000 ringgit worth of prizes. Plus, every month, the first 5 clients to trade 5 lots win 100 ringgit instantly. But that's not all. Enjoy brokerage rebates to reduce your trading costs. Are you new to futures? No worries. We have Affin Hwang's licensed FBR ready to guide you step by step. If you can help me to understand and to clarify whether I'm on the right track or not, whenever a person sees the US inventory goes up, the crude oil price tends to come down because there's anticipation that, you have so much inventory built up, you can release those inventory as and when you like. And we have seen it before when oil price went up to above $100 per barrel. That's what the US did. They released the strategic petroleum reserve in order to make the crude oil price come down artificially so that inflation don't go haywire. Right. That's how I understand how to read the US inventory numbers.
Yeah, I think there's one portion of it. You got one of context right, especially when the depletion of the strategic petroleum reserve will get very aggressive once oil price is high. Now, when I mention high, it could be relative. $100 could be high. 120 could be high. But those are high price environment, and in those cases, U.S. governments is also very sensitive to consumers. So if consumer are again very sensitive to inflationary pressure because of high oil prices, then definitely U.S. government will react and just to deplete those reserves. So I wouldn't want to use we can't rely too much on having that kind of linkage whereby if the government starts to use reserve, are we looking at lower oil prices just to artificially depress that? Now it really depends on how the government want to play out. But obviously that's a good indication. But then again, you also look at where the overall petroleum reserve is right now. Obviously, right now, if you compare to 3 or 4 years ago, the reserve levels are actually very low. So there will be bound a time where current oil price environment is actually very beneficial for government to do something. Whether they will start storing or start every month they will start to replenish those supplies. It could be. That's why we can't expect prices to come down too much because the US government are also trying to actively replenish those supplies. And if that's the case, that's also telling you that inventories will start to build up. So we can't really draw a direct linkage by stating that high oil price environment, low inventories, lower inventories, that's indication that price will be supported. It's very tough to say. But I will say this, I think when you have high oil price environment and you have good levels of strategic petroleum reserve, I think naturally you'll start to see inventories coming down. So that's a good indication to gauge.
Right. So that's how the US try to control the crude oil price to stay in the range that is not so disruptive to the entire economic system, right? Yep. But let's turn the attention to the Middle East, right? While the US use their inventory as a strategy to control prices, they have this organization called the OPEC, right? And OPEC, I think they are not so much about inventory and whatnot, but it's more about the production of all the OPEC countries, all the member countries. But what is confusing about OPEC is that one day you read the news, they say, I'm going to increase production. Then 2 weeks later, you read again, no, I'm going to reduce production. So how do we make sense of what they're trying to do? And is there a way for us to anticipate what they would do in the foreseeable future?
Okay, now when it comes to analyzing an oil market and in relation to OPEC, it's not an easy task. Now, OPEC is like a cartel. And in a cartel, normally you have member countries, and in a cartel, to make it work, you need compliance. And a lot of these countries, sometimes they go rogue. They will just say, okay, you as a cartel, we agree, we have done an agreement, you should only produce this X amount per day. But because of oil price, certain countries are very oil dependent and they need the oil revenue. In fact, not only some, I think majority of the countries in OPEC, they are quite oil dependent, or they need those oil revenues. So when the oil prices are actually quite high in certain ways, then it incentivizes these countries to go beyond what they've agreed. And there's definitely no compliance. And Saudi Arabia being a leader in OPEC is not easy. When you have member countries that's not following to what you have agreed as a cartel or as a membership group, that's where problem arises. So for example, I think Saudi Arabia has mentioned, I think almost like 1 year back, they try to restrict the barrels that's coming in per day. And you can see some of the members countries 3 or 6 months down the road, once oil price starts to go above a certain level, then there's more incentive for these membership countries to just go rogue, and they just don't want to comply with whatever the compliance. So it's very hard to determine OPEC actions. Although I think the major ones, if you are looking at the oil market, is to watch what Saudi Arabia is going to do, because their production is huge in terms of the cartel members. Now, the rest of others, like Crude and the rest of others, they are still important. But that they tend to react when oil prices are high. That they tend not to comply. So therefore, whatever they've mentioned, OPEC as a agreed group, whatever they have agreed to a certain supply per day, we can't use that as a basis to determine or to analyze it. So, to really rationalize what OPEC is doing is very difficult, and to predict what they're going to do is also evenly difficult. But I would say this, whenever Saudi Arabia mentions something as a representative of OPEC, it will definitely move market. And the other equation is whatever US is also doing, it also will move market, because these two, US is non-OPEC, and your Saudi Arabia is a major member in OPEC. They are pretty much leading the market. So I would say this, OPEC is very difficult to predict what's going to do, because there's always member countries that's not going to follow, and it's a tough job, really, to try to understand what they're going to do.
Right. If that is hard to predict, we haven't added in OPEC Plus some more, Plus being, you have Russia and stuff like that. But how much does all these OPEC Plus countries affect the crude oil prices? Because from my understanding is that Russia can be quite a big player and quite an important player in the market as well. So while they are not really in the OPEC, but whatever decision that they make, somewhat have quite an influential movement to crude oil price.
Yes, indeed. If you see this now, you have OPEC Plus with Russia being a very major contributor. Now, I don't have the specific numbers. I'm just going to use rough numbers. So OPEC and OPEC Plus roughly, let's say, they are producing the total production per day is talking about 100 million barrel per day. So I would say this OPEC and OPEC Plus probably estimated they probably contribute between 40 to 45 million barrels, so that's 45% of market share, and US is probably contributing 15 to 16%. So US is also very significant. Russia also very significant. They are also producing in the region between 10 to 15, so it's 10 to 15% of the daily production, oil production. So they are a very significant player. So understanding to really, you see the geopolitics between the oil industry has changed quite significantly once the US has actually introduced shale oil, when they start fracking, and this, if you recall back a decade ago, US was not even an oil exporter, they were an oil importer. And right now, when US came to the role, with the technology of fracking, there's more oil production, they suddenly reverse the role and they become an oil exporter. So there's always a power play between OPEC and OPEC Plus with US. So US is always, since they are now exporting, they definitely want high oil prices. And OPEC and OPEC Plus, they also want high oil prices. But OPEC and OPEC Plus is because they only can control their production. And there's always incentive for them to run as a cartel to control, because they are quite significant. They're talking about 40% of market share. That's huge. So they're trying to dictate prices. But US, on the other hand, regardless, to some extent, they disregard the prices of the market. As long as they are profitable, they'll still keep pumping. So there's always a power play between the OPEC Plus and US. So it's always a geopolitics involving in all these dynamics. But I must say this, Russia is very significant, OPEC also very significant, and US, these three are very major significant player in the whole oil context.
Well, at first, when I want to start this conversation with you, I was thinking in the direction of, oh, so what is the economic factor is going to affect oil price and stuff like that. But after talking to you for the past 10, 15 minutes, I realized that this is an international relations kind of topic instead of just talking about oil itself, right? But I want to shift the focus to the oil itself because I think that's what makes FAQ show audience interested most about. But when we talk about oil futures or the oil market, generally people straight away comes to mind is the two major products in the market. One is Brent crude oil and one is the WTI. Actually, what are the differences between these two? Because to me, crude oil is crude oil lah. How come you have Brent oil? How come you have WTI?
Okay, yeah. Now, if you look at, there's quality difference, but it's very minute. In terms of both Brent and WTI. But I would say the major differential is that the price benchmark, each of them cater to a different geolocations. Now, if you're an international player, whether you are in Asia or you are in the Middle East, you probably look at Brent because Brent is more of an international benchmark, where the deliverables are in majority are in UK and whatnot, or Europe. So there's a big market. So they are more relevant to that side of the world. Now, WTI is very relevant to US. And US now is a very significant oil player. So US WTI, they always use that as a oil price benchmark. They don't look at Brent. Now, in those days, when you compare these two in terms of prices, they're actually very minimal difference, or the spread between the WTI and Brent prices are very minimal. But nowadays, because of geopolitical involving, and there's obviously there's different intentions altogether, you can start to see the price differential between Brent and WTI starts to get wider. So I think the major the benchmark itself catering to a different location, and the US one is more relevant for WTI, and Brent is more relevant benchmark for the Asia and also the European players. So I'll say that's the major difference. Now, in terms of quality, they are very similar, but obviously when it comes to prices, there's still a difference between these two contracts.
Right. Speaking about prices, I noticed Brent oil always command a premium compared to WTI. Does that got to do with the cost of production or something like that?
Cost of production is one part. I think but the major part is the deliverables. The quality are very similar, so there's not much difference in quality. Because the brand has higher demand because it caters to more markets, like I mentioned, Europe and Asia, and to some extent the Middle East. So therefore, I think there's heavily more demand. So therefore, generally that's pushing the price premium higher, and therefore command a premium. Now, WTI is very relevant only to the US side. So the markets are generally smaller. And therefore that command a lesser demand for it. So therefore a price lower compared to Brent. Now there's also other variables that's involved. Mainly again is the deliverables, whether it's physical delivery. Now in European side, when you want to do deliverables, usually there's more logistical costs involved. While US, the famous is Cushing, Oklahoma, which is the WTI is based on. So there's pipes, and those deliverable costs are a bit lower in that sense. So therefore, usually price lower compared to Brent.
Okay, so there are a lot of factors that affect the price difference between WTI and also the Brent oil. Okay, so as a beginner futures trader, and I want to expose myself to the crude oil market, when I look at the platform, right, I notice it's quite confusing. First, you already have the Brent, you have the WTI, and then different products will have different maturity and stuff like that. So could you just showcase to me like how do I choose the right product to start trading? What are the characteristic differences between, let's say, if a contract is expiring next month compared to a contract that is going to expire 9 months down the road? And in terms of volatility, is Brent more volatile than WTI? That kind of characteristics. Could you spend some time to explain on that?
Yeah, sure. Now, if you are someone new to the oil trading, I will highly recommend to look at WTI, which is on CME platform, CME exchange. Now, WTI contract, even Brent itself, because they are mainly listed on the European exchange, the ICE and whatnot. So I would say this: WTI is, despite the geolocation is only catering to mainly the US side, but the volume that's traded on, especially on a futures contract, is actually quite heavy and very liquid product. Now, to choose a particular contract, as what you mentioned, futures contract involve different contract months. If you look at oil, you have contract right up to 10 years forward. So your futures contract is now trading at 2035. I have no idea where oil price is going to go, but that's a function of the futures market. It gives you a price. So, if you are someone new to the futures market, especially to oil, choose a contract where it has the highest traded volume, or even has the highest open interest. Why is that so? Because when you have a contract that's high open interest or high volume, it means that contract is liquid. Now, you don't trade contracts, let's say, even a year forward. Even though there's a price there, the volume may be very restrictive. There's less volume there. So therefore, if you are trading those style of contracts, the bid and ask can be quite wide. And that means it's more transactional cost for you. So if you are new to the oil market, futures market, look at the contract month that is, has the highest volume and the highest open interest. Now, one thing to take note is that, the margins in oil futures contract can be relatively quite high. Now, I think with CME introducing the micro contracts, which the margins are very more friendly in the sense that it's a smaller contract. It allows, individual to gain a participation in the market. I think those contracts are easy to start off with. Those days, if you trade oil contract, one thing, in futures contract, I wouldn't say the downside, but you trade like a commodity futures contract. One thing you must be always careful with is the physical deliverables. You don't want to be holding a contract. At the end of the day, Affin will call you and say, hey, look, I have to deliver to you, 1,000 barrels of oil. 1,000 barrels, not one barrel, it's 1,000 barrels. I'm not sure how many years you're going to take to consume 1,000 barrels. So that's a point you need to take note. So, I'll say this for someone that's new to oil market, especially to looking at which particular month to trade, which futures month to trade. Look at the highest volume and look at the highest open interest. That means that particular contract month is actually easy to trade. So normally when you trade oil futures, the heavily active contract usually be the second month. So right now, it's either May and June contracts will be heavily traded. So do look at those months. If you look beyond that, you start to see those contracts start to trade with lesser volume. So that means there's higher transactional costs for you. Now, second thing is also to take note of is that, if you don't want to avoid deliverables, you don't want to get, suddenly you forgot to close your contract before the expiry and you don't want to answer those, physical deliverables, trade contracts that's a bit further away. But be mindful, those contracts may have lesser volume, and that's why you need to be prepared for as well.
Right, so those are very good tips for beginners like me to want to start. But what about yourself? Like you have been in the futures market long enough, and you have seen a lot of actions going on, and I'm pretty sure you will make use of all the contracts in the market to make the best position out for your benefit. So how would you do it if you are going into the oil futures market?
Okay, when I generally trade commodities, whether it's oil, whether it's grains, corn and soybean or whatnot, every commodity has a seasonal pattern, or we call it seasonal tendencies. There will be a particular period where, let's say, for example, April to June is the weakest period for, let's say, the corn contract. So for oil, normally this is the period where I think between March to July or August is what we call a strong period, because generally there's people flying, summer season in the US, people are flying, driving and whatnot. So there's generally higher demand for oil across the board. So because of this, generally we can take a position. So if you're looking at, you're expecting, let's say, for example, if you don't mind, Frankie, can I just share? I have a slides for that, so that'll be easier for me to explain and elaborate. Is that fine?
Yeah, sure. Yeah.
So just to make the explanation easier. So I just mentioned this. This is looking at all the different contracts across the board. So again, pick those contracts that has the heaviest volume. So right now, June or July contract has the highest volume. So that contract is easily traded. So to answer your question, how do I make sense out of it by looking at different contract months? Now, I just want to point to you this particular chart that I have here. This is a seasonal tendencies for oil price for the past 30 years. So if you look at it, if you break down month to month, you can see that from February to right up to August, September period, you can see generally oil prices tend to be stronger. Now there's a lot of reasons to it. Like I mentioned, it's a summer season. A lot of people are going for holiday, and therefore there's generally higher demand for oil. Now, if you just look at after or rather during the October period onwards, generally you start to see oil prices starts to come down. Now, why is it so? Because generally US or Northern Hemisphere is going to winter. There's less demand, less traveling and whatnot. So generally the demand for oil comes down. Now, if you understand these seasonal tendencies, what you can do is that you probably can take a long position around June, July contracts, and you can short the October, November contract, because futures market, you have contract that is traded on further months. So that's a good position that you can look at, or you can take a position. Now, this is just an example. And this particular strategy is called a calendar spread strategy. Basing on the seasonal tendencies of oil prices across the many decades and years. So this is just an example. What I will do if I were given, to illustrate to you how can I make use of the different contract months that's available on the market for me to take an opportunity.
Right. So general rule of thumb, if I go in, let's say I want to maximize from that calendar spread strategy, right? I would go in every year. In February, I will go long, and then I'll wait until August. Then I will short the maybe September or October contract, and then let it go down. And I do this for 30 years. Yeah, statistics will show that it is correct, right?
Yeah,
okay.
This is where I need to put out a disclaimer. This commodities itself, although it display over 30 years, this is the seasonal tendencies, but it could be that particular year where you do this strategy, it failed. And there is occasion and instances where it happens. Now, oil is a very dynamic market. If let's say suddenly there's a war happening between the Middle East or in certain parts of the world, you start to see the whole market go out of whack. And these seasonal tendencies will not follow. So these are the things that we got to be prepared for. But we can use this as a guide. If you are trading a market, we can use these tendencies as a guide, but we cannot rely 100% as a basis of our trade. You can observe it, as long as the market behaves in a normal situation. This is what we should expect. And if suddenly the market goes haywire or there's a out of whack because of political tension and whatnot, then you really can't rely on seasonal tendencies anymore. So I think this is where you really need to be cautious if you are trading the oil market, because there's also other factors which is more important than seasonal tendencies that can actually affect oil prices. Now, if you ask in general, how do we make use of all the different contract months? This particular one strategy that you can observe and look at is to compare the different months that is weak and strong, and therefore take a position. But I would not recommend that every year you expect the same thing, because there'll be bound to be a year where, let's say for example, like the COVID-19 pandemic, which disrupt the whole pattern of the market. If something like this, that kind of scale, it can disrupt the market again for the foreseeable future. So take it as a guide, but you can't really use it as a basis of trading.
Right, which is where I'm going to ask you my next question, right? Because this particular commodity seems to be so heavily dependent on geopolitical situation, international relations, and things like that. Can I then say that actually technical analysis doesn't work very well on crude oil futures, because you have other external factors that would affect how the technical analysis formula runs?
Okay. Now I think oil as a whole, if you're trying to trade this particular product, what I mentioned earlier, the factors, these are all fundamental factors that drive prices. But it's important. Why I would say technical is still important. It plays a role because ultimately you want to navigate the market. You need a strategy to enter and exit, and I think technical helps that with certain technical strategy or tools that you can use, you can navigate the oil market. But keep in mind, oil is a very volatile market. If you ask me, in my company or in my environment, when we have traders who trade the market, we always encourage our traders, if you are trading oil market, make sure, because it's a volatile market, make sure you always close your position at the end of the week. And we do that normally with technical technical tools, because that will help us to guide us which the particular price that we should enter and which particular price we should be exiting the market. So technical plays a very, I would say it plays a role in terms of helping us to navigate the market. But I think what drives the direction of the market is still quite fundamental drivers. So we talk about it in the beginning of the session. Global demand is why global demand is weak. Recession is there's a fear of recession, so therefore affecting demand. That's why you see generally the trend in oil prices actually been coming down because of that fundamental driver. So I would say it's an interplay between the fundamentals and technicals, and I think technicals it help us in a way to pinpoint entries and exit positions accordingly.
Right. Now, a lot of people say that fundamental analysis works especially when you invest in stocks. But when it comes to futures products, sometimes some traders, they don't even bother about looking at fundamentals. They just trade technical, right? But now hearing from you, it seems that fundamentals still play a very important role. But having said that, because the contracts typically is like 1 month, 2 months, 3 months. So how well can fundamental plays out within this time frame, and does fundamental really matters apart from, let's say, for example, like you mentioned, COVID-19 that makes the whole market go haywire? But assuming everything runs okay, a lot of arguments says that you don't really need to bother about the fundamentals. What do you think?
Okay, I think to a certain extent, fundamentals can play a role. In fact, in certain ways, it can be quite significant, because why I say that is, now if you just look at the drivers, some of the key drivers of oil prices, mainly down to China demand, and because China is a very huge economy. Now, if China were to, let's say the PMI number starts to deteriorate, then roughly people are expecting that China will not do well. And going forward, with this property crisis as getting very intense, and it's actually prompting that, it's giving a hint that the future demand for oil coming from China is going to be weak, because they are facing an economic onslaught with their property crisis that's in play right now. So if you take that, you can roughly gauge the sentiment of the market. So fundamentals, in a way, it shapes you how the market perceives the sentiments are right now. If I just shared again the slides, I just want to point the discussion. I think this is very relevant. If you just look at, this is what we call a forward curve. Now, if you plot all the oil contracts, monthly contracts, and you just plot their prices accordingly, now you start to see there's a sharp downturn, especially up to 1 year forward, up to next year. This is basically indicating to you that the market in the foreseeable months are showing you that the market is generally not strong. Oil market is definitely heading further down south in the foreseeable months. Why is that so? It's mainly driven by economic factors. It could be China, it could be the global economy. So fundamentals actually drive sentiment, and sentiments reflected in the price. So I would say this, if you are looking at commodities in general, sometimes fundamentals does give you a sentiment play, and it shapes the sentiment across different months. So in oil price, you can very safely assume that given the condition right now, the prices for the further months are trading way below prices that we are seeing right now. So I think that's how I would say fundamentals are still important, and it's still quite crucial in this role.
Right. So go back to your chart earlier, right? There's if you look at further down 10 years later, the price goes even lower. Does that mean that the futures market is anticipating for the demand for the future will be lesser and lesser, and therefore the prices drop? And perhaps if that's true, I suppose it's coming from EV and the green energy and stuff like that, right? So does that mean that the future for crude oil futures is bleak, and one day there wouldn't be crude oil futures anymore? You will start trading something else.
Okay, I think what the curve just now I showed to you, if you look at 10 years later, the curve, prices are trading way below 60 now. This time market does indicate to you going forward, whether it's because supply is abundant or demand is weak. Generally, the market is those contracts that's further out in the months are trading way lower. Now in these markets, it just generally tells you there's no positive factor, or rather there's lack of positive factor that can actually drive or support demand. So therefore prices are traded at very least. Now, this one I mentioned structural shift like EV play is very structural. I'm not sure how that translates to prices, because oil prices is what we can see in scope is only up to 10 years. But then again, I think why you look at 10-year prices, again, those are not very reflective of where the actual demand is, because it's very hard to predict what is going to happen. Even up to, for oil market, you can predict 6 months forward. It's fabulous, because oil market can change very dynamic. It's a very fluid market. So if you look at the curve just now I showed to you, it's just telling you that generally going forward, demand is going to be weak or supply is going to be abundant. That's why the curve is portraying as it is. Now, structural things like EV play, now this is again I would say it's a very long-term thing, not necessarily translated to prices yet. But I think generally we are expecting that if you look at long-term prospect for oil, EV is going to be a very big competition, and therefore generally that's going to translate into probably weaker demand going forward, and maybe that's explain why prices in the 10 years later is trading as where it is. That could be a factor, but I think what important if you look at it on the on the holistic point of view, prices are trading at why the future prices are trading like that is mainly because that people are just generally expecting demand is going to be weak going forward. That's why prices in the foreseeable months it should be lower compared to the current months.
Right. Well, fantastic conversation with you today, David. But of all the things that we're talking about, right, it still seems that it is very hard, very difficult to grasp the pulse of the crude oil futures market. So if let's say today a new trader would to enter the futures market and want to expose him or herself into crude oil futures, what are the 3 advice that you would give this person?
Okay, I would say this is do make sure you have sufficient knowledge or reading when it comes to oil market in general. I think secondly is that if you are new to the markets, to the oil market space, start small. And I think now is a great time to start, because first of all, market is volatile. Secondly, we have you have CME. They have started to introduce micro contracts, which margins are probably, I don't have the latest margin. Probably you can check with Affin for the latest margin. But a contract probably only costs you $500 as a margin, which is very small. If you look at a big size contract, you're looking at $5,000. That's a huge amount to undertake. So $500 is a good amount to start off with, and I think that gives you an opportunity for you to understand how the oil market works. And I think the third advice is oil market is highly fluid and highly liquid. So you must make sure you have a proper plan in place. When I mention plan, is referring to trading plan per se. You have a plan to enter and exit accordingly, because oil market it can because of one news or one piece of headline news, it can really move market. And market is so sensitive right now, be it whether it's a trade war that's going on, but it's also very sensitive to other major factors. And because of this nature, trading oil market requires you to make sure you have a proper plan in place every time you make a position in the market. So I would say these are the 3 pieces of advice. I would say this is an opportune time really for someone that's new to oil market to start looking at the market through all these micro contracts that's available for you on the open market.
David, I think one thing for sure, right? If you want to look smart and seems that you know everything that's happening around the world, start with crude oil futures is the way to go.
Yeah. Or if you want to torture yourself mentally by not sleeping as much, trade oil contracts.
Right.
Because trust me, any news, and the problem with trading oil contracts is that news always come out. News that affects oil market always come out during the weekend. So you are already so pressured by Monday to Friday, and suddenly over the weekend if you have oil positions, you also have to be pressured by that. So oil is a very different dynamics altogether.
Right. That's the reason why you tell your traders to close their position at the end of the week so that they can prepare themselves for the next week.
Yes.
Right. All right. Thank you so much, David. Thanks for your time. I had a very great insight from you and learned so much about crude oil futures today. Hope to see you in person soon. Then we can have more conversation next time.
Definitely.
Right.
Yeah. Thank you.
See you.